Well, good afternoon, everyone. As you just heard, we're the Mitigating Risks panel. We're hoping to talk about some compliance issues, some bias issues, and maybe a couple of other issues, depending on where the panel decides to go. My name is Mark Rasich. I'm a shareholder at Greenberg Traurig, international law firm with offices literally all over the place. Lots of fintech and banking clients in the major financial areas and also around the corner. Would each of you introduce yourselves?
Well, great to be here, and thank you everyone for coming after the coffee break. I hope you're all energized. My name is Elizabeth. I am a managing director at Cubica. We are in digital consulting and services, especially in the finance and banking industries. So we work, for example, with community banks, such as Coastal Community Bank, with payment providers, such as ACI Worldwide, and a lot of different players in the field, and help them, with their data and AI, needs and challenges. And looking forward to talking a little bit more about that.
Hi, thank you everyone for coming to our panel. We know that we stand between you and the cocktail hour, so thank you for showing up. I'm Marty O'Malley. I'm an assistant general counsel at Prosper. Prosper is an online lending marketplace. So we are the fintech partner. We partner with our partner banks to offer the products. So we offer a personal loan, a credit card, and a home equity suite of products. And I focus on our borrower regulatory, our borrower-facing litigation, and our public policy matters. Also, I'd like to throw in a little pitch for the American FinTech Council. I'm the chair of the board of the AFC, proud sponsor of this conference. We also all welcome all of our members, and thank you all for coming.
It's hard to follow that.
Yeah, I know.
I'm Annie Delgado.
I believe in you.
Well, thank you. I'm Chief Risk Officer at Upstart. Upstart is also a online marketplace lender. We connect consumers who need credit with a network of about 100 banks and credit unions that offer various types of credit. We do personal lending, small dollar lending, auto lending, and HELOC. And our sort of main mission has been applying AI and ML to credit underwriting, basically since our inception, although our models have been getting smarter and smarter year over year, and so what words we use to describe them has also changed over time. We basically believe that through better data and advanced algorithms, you can approve more people at a lower cost. So we apply our AI and ML both to credit underwriting and also to the sort of verification phases as well. Since you did a plug, I will also do a plug. I'm also a co-host on a podcast called What the AI. So if you're interested in staying up on all things AI, my co-host Jeff Keltner and I nerd out about it every week. So you can look it up on Spotify.
Hey everybody, I'm Kareem Saleh. I'm the founder and CEO of Fairplay. We are the AI enablement company for the financial services and insurance industries. We help financial services and insurance companies build, test, optimize, and validate AI models. Some of the biggest names in financial services use our software to identify and correct blind spots in their AI models, which allows them to make more money and do more good.
All right, let's start broadly, and I'll start with you, Kareem. What are some of the bigger, let's just start with AI issues, not necessarily specific to compliance, but bigger AI issues you're seeing in the space where you work?
Yeah, well, I think the first thing to understand is that AI without big data is incomplete. And so if you focus in on the data issues for a moment, as lenders, you've got lots of variables that we all use every day that appear on their face to be related to creditworthiness and legitimate for use. But the problem with AI is that it's so computationally complex that sometimes even the seemingly fair variables can interact in your credit models to encode information about prohibited bases. Let me give you an example of that. So we work with a subprime auto lender that operates in the Western United States. They had like 2 variables in their model, which at first glance seemed totally reasonable. The first variable that they were using in their model is, what's the mileage of the car that's proposed to be purchased? And if you think about that, has a totally reasonable relationship to creditworthiness, right? Like the higher the mileage of the car, the more likely it is to break down. The more likely your car is to break down, the more likely you are to miss work. The more likely you are to miss work, the more likely you are to miss a payment, right? So totally legitimate credit variable. Another variable in their model was, do you live in Nevada? It turns out Nevadans have a slightly elevated risk of default compared to other states. I don't know if that's attributable to Nevada's long association with the gaming industry, or if there's something going on macroeconomically in Nevada, but Nevadans default at higher rates. And that was also a variable that did not pose immediate compliance concerns, because it's not like, do you live in a particular neighborhood in Nevada, which could be redlining. It was just like, do you live in Nevada? So 2 variables, both of which pass compliance. Only one problem with that. If you're buying a high mileage car in Nevada, there's like a 70% probability that you're a person of color. So like, you think you're making a decision on the basis of state and mileage, you're actually making a decision on the basis of race. And so that's one of the key concerns that arises from the use of AI models, is this risk that seemingly fair variables will encode information that no human could possibly discern just by looking at them. Now, another risk you've got arising from the data that you might be using is the kind of state-of-the-art in credit underwriting is cash flow underwriting. And the idea is that, by having visibility into the transactions into and out of a consumer's deposit account, you get a much clearer picture of their balance sheet. And that's true. Cash flow underwriting is extremely predictive. But it also raises all kinds of other questions. You're now, for the first time, going to have visibility into transactions you never had before. So take a variable like tattoo spend. Tattoo spend is highly predictive of credit risk, especially if you're getting that tattoo at 2 a.m. in the morning. But it turns out that like tattoo spend also like skews black. It skews young. It skews male. So like, should you be using tattoo spend? What about spend at other kind of retailers that might be disfavored for one reason or another, right? Spend on smoking, spend on adult entertainment, spend on gambling. All of that stuff is predictive, but it raises all kinds of compliance and ethical concerns. And then finally, I think a third concern that we should all be paying attention to, especially in a choppy macro environment, is that sometimes these models drift, right? And they assume a stable macro environment, right? So we live in an environment now where we've got tariffs. We live in an environment now where we've got inflation. We live in an environment with elevated geopolitical risk. And none of your models was calibrated to account for any of that. And so one of the, for example, a borrower that, you underwrote pre-COVID as having $5,000 a month in monthly income, well, that borrower probably has effective income of $4,000 a month today. How has your model been calibrated to account for that? So there's a whole set of concerns related to the accuracy and stability of these models that you also have to be attuned to in a choppy macro environment.
I think I would add to that list of things to worry about, just so you guys all have good fodder when you go to cocktail hour. But other things I think that are common issues with AI that people talk about but are actually really challenging to implement strategies around are the explainability aspect. So if you are, maybe we have some folks in this room that are the 2 a.m. tattoo parlor folks. If Kareem's lender is going to decline you for that, how is that explained to you that actually impacted your creditworthiness when really you should be able to get a tattoo whenever you want? So that explainability becomes a challenge because of the very issues that he just raised in terms of the massive amount of data that's now available to lenders for use. And even if it meets the sort of fairness threshold, how does it meet the explainability threshold, I think is another thing that is a challenge.
I'd like to pick up on that a little bit, which is a slightly different variation on that. The models are built on hundreds of pieces of data, and not every person here or not every person who applies for credit will have all of those pieces of data. So you can't not assign a value to that data. A model built on 100 pieces of data is very different from a model that's built on 99 pieces of data. So you then must assign a value to a piece of data that doesn't actually exist for a particular consumer. How do you assign that value? Do you choose the neutral value? Do you choose a slightly good value? What do you do with that value? And then, if that value, you must also weight that value in the functioning of your model. And then if at the end of the day, after you've done all of your things, it turns out that that is the piece of data that declined the applicant, that's one of the top 4 reasons, how do you explain that to your customer? And the answer to that question is you tell them the truth. You tell them that that variable that doesn't really exist for them is the thing that one of the factors that they were declined on. But that is an explainability problem. You must tell the truth, but it doesn't necessarily make sense to the customer.
And to add to that, on top of the explainability, there's also the matter of auditability, and to be able, to really trace back any type of output from models to its source, and understand why those decisions, why those inputs were generated and based on what. It's not really just about predictability, but again, also about auditability. And another point, and this was actually raised in the previous panel, but I think it's good to reinforce that, is the risk of cybersecurity attached to AI models. We see the risk of attacks, related to prompt injections, to SQL injections. And one of the things that we have implemented, for example, is that really cybersecurity teams and data and AI teams have to work really closely together to mitigate the risk for those kind of attacks.
So picking up on a couple of those issues, how are you all seeing businesses or companies who are providing services address what I'll call model drift, of the way we were talking about, where it starts off okay, but over time, maybe it's veering into dangerous territory, or at least it's less predictable, less explainable. How are you addressing that? Anybody want to take it first?
Maybe our case is very specific because we are the ones who help other companies do that. So part of our responsibility as a service provider is to ensure that we have a team that is ready for that. So that includes, for example, AI upskilling, training with Gen AI, but also training on governance platforms, such as Databricks or Snowflake. We have, for example, from our 800 plus team members, over 200 certified with Databricks. These are decisions, conscious decisions that we make as a company to make sure that eventually the work that we might be implementing with all of those risks and areas where you really need to be knowing what you do, that we as a company, make those responsible choices of understanding how our people need to be trained.
I was just going to say, one of the big challenges that I see a lot of firms deal with is that their compliance and risk oversight mechanisms are not keeping pace from an innovation standpoint with their business mechanisms. And so if there was one thing that I would recommend, and it's not just selfishly because I want all the compliance and risk people to have jobs, but it's really, really important to invest in those teams, because the traditional approaches to compliance and risk management just are like complete box checky, not useful for AI. You have to be doing things like fairness observability every day. In the old world, doing a fairness test once a year was sufficient. Now, if your models are using AI and they're getting recalibrated on a regular basis, and we have this choppy environment where things are changing at a much more rapid clip, if you're not observing the sort of real data around the inputs and outputs of your model on a daily basis, then by the time you get the results of that audit, it's already light years behind from a technology standpoint, because the technology just moves so fast. So I think really investing in the observability tools is clutch. If you don't have the in-house staffing to build those types of tools, there's some great people up here who have companies that do. You should chat with them at cocktail hour.
We did not talk about this before.
But because there's a lot of cool tech out there, but it's not something that anybody can really afford to wait to invest in.
Yeah, model drift is a big challenge to your business, because your business is built on extending credit products to consumers out there. And if your models aren't working properly, then you won't reach those consumers, and your consumers also may not repay you in the way that you projected that they would. So it's really important to observe your model. It's really important to keep an eye on the performance of your models. It's really important to back test your models. And in addition, it's important to really use other inputs aligned with the models, because the models were built and trained on a data set that occurred in the past. but you're looking to deploy your models in the future. So your models can be only a very strong input into what you're doing, but you also need to be able to swap in and swap out depending on the changing economic conditions. So being able to watch for model drift and also applicability to future conditions is really important to the performance not of your model, but also of your business.
Yeah, I mean, picking up on something that Annie said, you can't have decisioning systems for the AI age and compliance systems from the Stone Age, right? You've got to be as sophisticated in your governance and your monitoring of these models as you are on the business side where you're using them. And by the way, as you deploy these models across the customer journey, you've got to start asking yourself, are the marketing decisions being made by the models reasonable? Are the fraud detection and income verification and identity verification decisions being made by the models reasonable? How about the underwriting and the pricing and the line assignment and the account management and, heaven forbid, the collections and loss mitigation? So you need infrastructure across that customer journey to allow you to understand if the models have broken or something in the world has changed. You need to understand, do the inputs remain reasonable? Are the outputs reasonable? Or the outcomes within tolerance. And you need to basically build that infrastructure to allow you to move as fast from a compliance and governance perspective as you are kind of on the business and decisioning side.
So the regulatory environment is vast and patchwork, but some environments like the EU AI Act require human interaction for certain activities, and one of which is business finance decisions. How are you seeing, or where are you seeing companies and businesses insert into the AI model human interaction, human oversight of decisions that those models are creating?
I think once a model is very sort of baked and you have all of your governance framework around it, you might be able to sort of trust that model to fly a little bit more on its own relative to a newer model. I think probably the most troublesome areas that we've seen a couple companies come out with is, I'm just going to outsource all my customer service to, ChatGPT or Anthropic or whatever. Maybe not the best strategy, because ChatGPT can't count the number of R's in strawberry, right? So even though it's wildly amazing in terms of all of the things that it can do, you still have that hallucination risk. You still have things that it's going to get wrong. I think you still have risk in terms of just like, is this model going to represent the vibe and the culture that I want my customers to experience with my organization? So things, if you're exploring use of things like generative AI, I think the sort of bar for human involvement and oversight is a lot greater than if you're using something that maybe is more homegrown and you have a lot of sort of tight controls around. So it's definitely not a one-size-fits-all that you can apply to your oversight of AI, because different AIs have different risks. And you asked about the regulatory environment changing. The reality is, as much as goes on in Washington, there is no way that the regulatory environment can ever keep pace with the pace of technology that we're seeing today. So as a compliance and risk team, you almost have to be thinking ahead of the regulation, and you have to be sort of imagining what's going to come down the pipeline. And oftentimes that really just starts with asking yourself, Martha just brought it up about being honest, but what is really best for my customer? And if you're leading from that, then you're going to feel comfortable sort of defending it in any sort of situation. So really thinking from the customer viewpoint first and understanding the risks of different models and how it interacts with the customer. I think it's just really important conversations to invest in.
I think there are two ideas that are a little bit in tension here. In your credit underwriting models, your machine learning models, you actually don't want to have a lot of human in the loop there. That is actually where bias comes in. Bias comes in the ability for humans to make judgments that are different from or outside from what the machine learning models tell you. On the other hand, in your AI models, where the AI is interacting with your customer, it might be in customer interactions, you might have used the generative AI to figure out ways to send back communications to your customers. You do want a human in the loop there. You want to make sure those interactions are fair, they're accurate, they're useful, they're helpful to the customer. That is where the human comes in very helpfully there. So it really depends, like where you want the human is in the stage of the process.
One example that is not from financial industries, but from a different regulated industries, in the sense of that this was a product for children. We had a case of generating AI images for children's tales. And in certain contexts, for example, surrounding pools, we started to see that images started to be generated in a sexualized way. So that, for example, is where we as humans, we had to, on the one hand, go in and look at different ways of retraining the models. We had to put up guardrails. We had to look at different benchmarks of other types of models to really re-rail again the output of this model that just went off track. So it really depends on the model. But it also depends on who your audience is and how sensitive the kind of information is that you're creating or the kind of impact that you're having.
Well, I mean, you mentioned the regulatory environment, so I thought I might just say a word or two about the regulatory environment. So it is a very interesting and I would say tricky time for lenders and financial institutions, because on the one hand, we've got an administration that is very pro-AI, very pro-growth, very pro-innovation, and they've taken all the cops off the beat. So you might think that now's the time to kind of put the pedal to the metal. On the other hand, when they dismantled the CFPB, where did all those CFPB examination and supervisory people go? Well, they went to New York, and they went to California, and they went to Maryland, and they went to Illinois. And those states are all stepping up in a very big way. Plus, the administration has actually shown that it does care quite a bit about some of these bias issues. You see that most clearly in some of the statements around debanking, where they're very concerned that folks who are involved in so-called politically disfavored activities are losing access to the banking system. So I think it's actually, the regulatory environment is maybe more complicated and nuanced than it seems, and I think financial institutions have to really figure out how to kind of thread the needle and navigate a sticky wicket the next 4 years.
What kind of pressures are you seeing from regulators in terms of establishing, proving, and the ways in which you would prove that your AI is not, we'll call it, logarithmically biased?
I think, well, so for us, it's really comes down to looking at the testing. And so, and I think piggybacking on what Kareem just said about the regulatory environment, the types of questions that are getting asked in exams haven't really changed a whole lot, even though the tone at the top has changed. So that's, I think, one thing for lenders to sort of stay aware of, that even though there's this sort of change in tone at the top and different messages coming out at the top of the house, on the ground, the exam manuals are still the same. The questions that are asked are still the same. So I think it really starts with looking at the results of testing and then digging into how you got comfortable with certain things. And so if you have, like I said, a well thought out, well documented approach that you feel comfortable defending, the regulators are usually very open to that. And even though you work with different regulators, all with different sort of levels of exposure to AI. Some of them have never encountered an AI system before. And so learning how the testing works and sort of getting educated is new for them. Other people maybe have had a bad experience with it. So really it's just a lot of conversation and a lot of, showing your work is really what wins the game.
I would say that Annie and I, or Upstart and Prosper, have the benefit of longevity in this space. We've been doing machine learning models and have done AI from inception. So we have the benefit of having weathered different regulatory regimes, different administrations, different economic environments. And if you've set your risk tolerance and you've set your values, and you can demonstrate, to Annie's point, that you can show your work, you establish a track record time and time and time again. So when regulators come with questions, you can say, I'm doing this way today, I did it this way yesterday, I'm doing new stuff, but I'm doing it in alignment with all of my values and the way that we do business for years. And that is really very meaningful and impactful for regulators when they come by.
I think Really one of the main issues or concerns that we have, are around data privacy and compliance with regulations, and especially in the context of, GDPR, of, also HIPAA compliance, of different types of regulations with financial institutions. There is an obvious risk. What we see as one of the really strong foundations to combat that is, everything regarding data governance, and is, using platforms such as Snowflake or Databricks to make sure that, everything that you have as far as your data foundation is secure, is robust, and is, set up in a responsible way, really to start with.
I guess one thing I'd add is that, one of the innovations that AI enables is that for any predictive problem, there is not one unique solution, which is to say there is not one best model necessarily. There's usually a multiplicity of models that would achieve your business objectives. And so it's, I think, extremely important when you're deploying an AI system to ask yourself, hey, is there some variant of this model that would perform within my risk tolerance, but also perhaps be more inclusive? And the reason that that matters is that these AI systems have a tendency to overfit to the populations that are well represented in the data. And that means that your models can develop blind spots. So for example, if your models are trained on high income people, they might struggle to underwrite low and moderate income people. Or if your models are trained on populations that are mostly in the Western United States, they might struggle to underwrite folks who are in the Eastern United States. And so I think it's extremely important that lenders not fall prey to the natural tendency in these models to overfit to populations that are well represented in the data, and spend some time investigating whether there's some variant of the model that would do a better job by these populations that are less well represented in the data, these populations that are perhaps inherently harder to score because the data about them is more likely to be messy, missing, or wrong. And I think if you can demonstrate that you evaluated a range of models, a range of AI systems, and then expended some effort and committed yourself with seriousness of purpose to thinking thoughtfully about where on the range of options you should land, both with respect to your business objectives, but also the communities that you serve, that you'll be in a good position to kind of defend your AI systems from regulators, either at the federal, the state level, but also consumer groups and other stakeholders that might inquire.
So who is doing the analysis that you're describing there, Kareem? Is it internal people, or are institutions hiring outside businesses to do that?
A and or B, yes. I mean, Upstart pioneered doing this work internally, and shameless plug for those of you who don't have Upstart level capabilities, call Fair Play.
I think if you're going to build it internally, one thing is it's really important to have separation of church and state between the overseers and the model developers. So that's something we fortunately were able to set up really early. So we have a team of really amazing, we call them the machine learning integrity team, and they're PhD statistics kind of people that could build models and could develop models and work on our core AI team, but we instead have them deployed to thinking about how to challenge and oversee the models. And that's worked really well for us. But like Kareem said, if you don't have those on your team, call Kareem.
We have that as well. We have a group of really amazingly talented data scientists, and the data scientists work on different products. And so if they are validating, you can use a team that works on one product to validate another product's model, and vice versa. We also have segregated teams in terms of who develops, who validates, who backtests. So by having different eyes on your models through these incredibly talented people, that really helps to ensure integrity of your models.
Maybe just as an interesting fact, besides the actual technical teams, what we see evolve today a lot is also the role of an AI or data product manager, who is more at the intersection of business needs versus the technical aspects of building an AI model. I think it was also on a previous panel where it was mentioned, we're getting paid, to do our job based on ROIs, and it is important that any type of adoption of AI into your products, follows kind of that rule. And so having really data scientists, data engineers, machine learning engineers, but more product focus, I think is also one of the areas that will fill that gap.
And I would do a shameless plug. Rely on your legal and your risk teams. I mean, these are people who are evaluating all of your technology on the way in, at inception, at the build phase. And these are people who are saying, explain this to me at the testing phase. So those are your key controls that you should really rely and integrate those teams into your AI usage.
So I was going to give you each an opportunity to provide the audience with an example of AI working to root out bias, or Martha, you and I were chatting about this earlier, about using it, not being so afraid of it because of the fact that bias could enter into the algorithm, but instead using it to weed out human, even unintentional, but human bias.
Yeah, so I'm a believer in models and in machine learning and in algorithms. I think in the early days of using these technologies, there was trepidation, there's the black box, you can't explain it, I don't know what it does, I don't like it, I'm afraid of it. But I think we've evolved so much in that time. We have a much greater insight into the kinds of variables that go into the models. We have much greater insight into the weight or the importance that can be given to these variables. We understand even after we deploy a model, there are still populations that after seeing how the model performs and seeing repayment risk and seeing trends in the models, we can come through the models to find additional populations of people that we may have missed, but now we can include them in our credit box, and we can reach those people and we can find those people, excuse me. And what is really, I think, important is that fair lending and good models are good business. They align to everyone's needs and desires. So you develop this virtuous cycle by having a model that does not have bias and also includes and is inclusive of fair lending and more customers.
I think one interesting case is bias-aware data augmentation. Where basically you generate synthesized data, but that is realistic for underrepresented, data segments. So bias is there. The question is, do you detect it? Do you understand it? Do you prevent it from generating outcomes that are not fair, or that are that just have a bias that you want to avoid?
I think there's a couple of maybe commonly misunderstood, maybe not by the folks in this room, but broadly misunderstood ideas that need to be dispelled. The first is when you look at non-traditional variables, people assume you're using them in a traditional way. So using the tattoo parlor example, just because I love it and it's very provocative, it's not like anybody has in their underwriting policy that tattoo parlor at midnight is good, tattoo parlor at 3 a.m. is bad, and it's some sort of hard rule. They go into a giant machine that maybe some people, 2 a.m. tattoo parlor behavior is actually a good credit signal, and for some people it's bad because it's continuous and it's getting an entire picture of the person. And so a specific data set is not necessarily always good or always bad. And so using that sort of non-traditional technique, you can approve more people because you can see more signal by those connections. So that's one thing that I think is misunderstood. And then I think the other thing that's misunderstood that Martha touched on is there's this sort of weird assumption that disparate impact analysis is somehow not business friendly, and it's going to make you have to have weird trade-offs and decline people you actually want to approve so that you can achieve a fairness objective. But actually, it is the opposite. It's extremely business friendly because it's allowing you to serve people that your traditional credit signals can't see as credit worthy, and that allows you to serve more customers. And the last I checked, when you serve more customers, you get more revenue. And so it's win-win. You get more customers, more loyalty, more revenue. So it's good for everyone. And I think, the proof is in the pudding. When you look at some of the outputs of these models for Upstart, we do an access to credit study every year. And, the metrics move based on what's going on in the world. But consistently we see that the Upstart model approves about 30% more people at a 30% lower APR than a traditional model. And it does that across sort of every consumer segment that we're testing across race lines and gender lines and age lines. And so that's actually the power of debiasing your models, is that you can actually just do business with a lot more people. And that is a great thing.
And oftentimes, you know, the way to achieve those gains is by making sure you're not over-relying on certain elements in the data. So let me give you an example. Consistency of employment is a variable we encounter all the time in credit models. And if you think about it, consistency of employment is a perfectly reasonable variable on which to assess the creditworthiness of a man. But all things being equal, consistency of employment is going to have a disparity driving effect for women who take time out of the workforce to start a family or care for a loved one. And so maybe before you over-rely on consistency of employment, you should tell your model, hey, you will sometimes encounter a population of people in the world called women. Women will sometimes exhibit inconsistent employment. Maybe before you decline somebody for inconsistent employment, you should do a check to see if they resemble good applicants on other dimensions you didn't heavily consider. And what we find is that something like 25 to 33% of the highest scoring folks that get declined would have performed as well as the riskiest folks most lenders approve. So that allows you to increase your approval rates, increase your take rates, and increase access. That's good for profits, good for people, good for the communities you serve.
I can't tell you how many times in my life in various industries I have wanted to say, you will sometimes encounter a group of people called women. I love, that's the best line ever. That is the takeaway from this session. So good.
And they're pretty smart, too. Look at my peers.
I think we're just about the end of our time. Maybe we have a time for a question or two. Anybody? Do we have time for a question or two? Or are we? Sorry, you'll have to get them at the happy hour. Anyway, thank you all.
Thank you.